Hello everyone, this is Chris Ragland, the Chief Operating Officer for Noble Capital, and welcome to our 2017 Q3 State of the Company. You've probably received a few emails from us teasing out this. We're just going to get into some of the data today and really get into facts of where we are as a company at the end of the third quarter. I'm also going to be joined at the end today of the presentation by our Chief Financial Officer, Grady Collins, where we will handle the Q&A session. So with that, I'm going to jump right into the presentation. Again, we tried to distill this down to just the vital few things. So for those of you that aren't familiar, although I know many of you or you've seen my name before, I'm the Chief Operating Officer for Noble Capital, and I handle just about all of the day-to-day operations for all of the divisions of our company. That also includes our financial practice and even our real estate department, which I'll talk a little bit more about later. And again, I mentioned I'm joined by Grady Collins, the Chief Financial Officer as well, for the Q&A session. So with that, we're going to jump right in to the presentation. Thought I'd go through a little bit of what we're going to talk about. So we're going to have the portfolio performance first, which for those of you that have seen this in the past are probably quite familiar with. I should also mention that you're going to get a mailed copy of our pamphlet that we send out. That's the multiple pages of the graphics and all the fun stuff that we see during this presentation. You'll be getting that in the mail over the next week or so. So be on the lookout for that. We're also going to talk about loan production and concentration, what changes we saw over this previous quarter. Let's see, jump into the Signature Fund, since that's now our largest fund, and we've put a lot of effort into growing that fund. A lot of our new clients are going into that fund. We're going to highlight some items on that in particular. And then we're going to get into a little bit of the portfolio fund or our REOs. Those are the products that we've taken over from the portfolio. And then, of course, at the end, we're going to address your questions. So without further ado, and a couple of announcements too, just for fun, we'll jump right into the data. So this is a pretty busy slide here, so I'm not going to spend too much time on it, but it does show you a little bit of historical record keeping, if you will, in terms of how we've done. This is a lot of data, and I'm going to jump into the details. I think this is usually the first slide we start off with, and this is just what's the total size of the portfolio look like. So as we're jumping into this, you'll see we've crossed over a little bit of a milestone at the end of the third quarter. In total dollars, we have $150 million under management for the portfolio. So that's definitely grown. Pretty obvious slide here when you see over time what we've grown. So that's up from 147, almost 148 in the last quarter. In terms of quantity of loans, though, it's actually dropped a little bit. You're going to hear a little bit about this as a kind of a theme in general for the last quarter, and that is we took it upon ourselves, and we do this about once every year or 18 months, and we tightened up our underwriting guidelines. And every time we do that, we see a short-term impact with our borrowers. It makes them a little bit more difficult for them to do new deals with us as they kind of make adjustments to get used to what we are looking for. And what are we looking for? We're always looking for a better quality loan, which results in a better experience for all of our private lenders. So we did see a tick down in terms of number of loans, and that's because the product mix changed a little bit. We started diversifying a little bit more and increasing the loans in Houston, and those loans, in Dallas as opposed to Houston, and those loans tend to be a little bit larger in the Dallas area. So you saw lower numbers but higher dollars. Speaking of average loan size, this is a little bit of an indication exactly what I was just trying to illustrate there. That's the increase in the average loan size that we see. Again, this slide is kind of interesting in that it's more of a trailing kind of review of the average loan size, because this only happens after the loans close, not what we see in the pipeline. So we're always seeing what new loan flow is coming in, and you've seen over the last 3-4 quarters now that slowly started to increase in terms of size. Again, this is a little relative though. When you look at the total dollar swing here, even 3 quarters ago, I mean, you're talking about, 439, 415, and right now we're hovering around 460. So when you look at this, even over a 2-year period, it's not that big of a change in terms of our average loan size. The total delta here is less than $50,000. So relatively consistent, even though the actual bar graph tends to move around a little bit here. Average loan duration, this is an important slide. We always pay a lot of attention to this, but there's a lot of details in the story. We're hovering just a little bit over 12 months. And if you see the last time that we saw it jump over 12 months, that was 3 quarters ago. So what happened at that time point? We actually had some loans pay off that were really, really long loans. And remember, those, we can only tell you how long a loan was until when it pays off. So that value is not factored in until after the payoff. So even though we may have loans in the portfolio today that have been over 12 months or even less, they don't get computed in until after they pay off. So some of the loans that we've had that were longer paid off, and that definitely edged it up just a little bit. But again, average loan duration, when you're looking at what's the change here, it's really about 1 and 2 months difference over a 2-year period. So again, relatively constant. Number of payoffs. This is always a good slide. Talks about the seasonality of payoffs as well as payoffs as a percentage of the portfolio. Relatively constant over the last 3 quarters. So Q3, we saw people trying to hurry up and hit the selling season before we moved into the 4th quarter. So I do expect, a drop in the 4th quarter as we look forward in terms of number of payoffs. But everyone tries to hit that seasonality. Sometimes they're successful, sometimes they're not. Either way, there's different motivations for the 4th quarter payoffs as well. They're trying to finish those properties and those projects before the end of the year and the tax bill comes due. So, but even so, relatively constant performance, which is always good here. Number of foreclosures. This is a slide that we pay attention to, again, in terms of just properties that we had to foreclose on and take over in that quarter. Again, relatively constant. You see over the past 3 or 4 quarters, it's looked at, 8, 10, 7. There's not a big difference here. If you're doing the math and you're kind of applying some higher order thinking, you're watching the portfolio grow in size, but the number of foreclosures staying relatively constant. That's good news for us. It's a signal that the overall health of the portfolio of properties is actually a little bit better. So over time, you start to look at that and you say, hey, if the actual unit count of foreclosures is not increasing at the same rate the size of the portfolio, that's a good sign here as well. So, okay, now we're going to get into the narrative of production and why we saw the drop. Again, if you look at us a year ago or a little over a year, you see the same type of behavior that happened, and we kind of expected that. So we changed quite a bit of our underwriting guidelines. What are we doing? We're trying to get better distribution throughout the state. We're trying to find new clients, new borrowers. And we're also looking for higher quality deal flow. We're always looking for higher quality deal flow, and that's what you saw here. So we see a retraction in the terms of loan originated in the 3rd quarter. It's encouraging to see that number is already picking up in the 4th quarter in terms of the run rate, so that's nice. Obviously, we would expect the dollars originated to be less as well. Not quite as big of an impact as we saw a little bit over a year ago when we did it this time, and that's because the average loan size, again, in Dallas tends to be a little bit bigger than what you see in, say, San Antonio or even in Austin. So the story is here, and if you dig into it, you can kind of see a little bit of that. But again, this was a little bit of a prediction. We knew this was going to happen, and we're already seeing the increase in production in the 4th quarter that we knew would happen once the borrowers make the proper adjustments. Loan concentration. So this has been fun to look at over the past couple of years in terms of where has the flow been, where is the exposure. For a while, if you've been with us for at least a couple of years, you may recall that DFW section was almost 0. It was in a single digit and the low single digits for a very long time. And then we had a lot of concentration in Austin, San Antonio, and even Houston. And at one point, Houston was one of the largest markets for us. So you can see a little bit better of a balance here, and that's intentional. Right, so the largest market as of today is Austin, of course, followed by Houston, which is we have a very strong presence in, and then we have San Antonio, Dallas, and the other market, all kind of about the same mix. This is a very healthy product mix for what we do and where the opportunities are. For those of you that are a little new to us in terms of this reporting, what does other mean? It is everything that's not those major markets, but generally speaking for us, it's the I-35 corridor that's not San Antonio, Austin, and Dallas. All right, loans per type. Generally speaking, if I was to just tell someone what we do as a company, we really fund 2 types of deals. and that's the major renovation deals, people that are flipping properties, as well as the new construction loans. They tend to be spec homes, infill development loans. Generally, these two tend to be pretty close to 50-50, but we're seeing more renovation loans now than we have in the past. And a little bit of that has to do with the client mix, which we'll see on the next slide. But the client mix, when we have new clients, it's a little bit easier for them in terms of pricing to do renovation as opposed to doing new construction the first time. It's a little bit easier for them to come in with us, do a first deal, and do some flipping than to do new construction. And we really feel like that's where this distortion or this change for the renovation being the majority, the 54 number, is coming from. On this slide, you can see what I'm talking about here. This is really usually very, very close to 50-50. So when it starts to move as much as this is, it may not seem like it, but this is actually a pretty big movement for us. And it's because we had to put a lot of emphasis on new clients and going after a higher credit class borrower in terms of the new deals that they're looking for. So again, more new clients that are coming in, resulting in more renovations in new areas that I'm talking about, such as Dallas. So that's the theme for this quarter. Okay, so that's the portfolio in terms of just everything in general. We're going to dive into a little bit of fund specifics. As everyone's aware, in 2017, we introduced the Signature Fund, and it became our primary funding vehicle. So a little bit of highlighted data. We crossed over the 10 million threshold mark in the third quarter for the Signature Fund. So total assets under management over 10 million. You can see there's quite a few of you guys participating in this, just under 50. In fact, the average investment size is a little smaller than our average loan, and that's because you're able to contribute your fractional loan positions into the Signature Fund. So we're looking at number of loans in the fund. We've got 61, and this is kind of neat as well. We can see what the average loan to value is in the fund, and it looks like it's below 65% LTV, so very nice and conservative in terms of the numbers that are here. Let's look at some of the data just a little bit deeper. Kind of curious as to who's putting what into the fund, the Signature Fund. We're looking at cash versus notes. So many of you are choosing to contribute your existing note in our PLN into the Signature Fund, which is a great way to take an existing investment and immediately get that diversification. So if your loan qualifies, you're able to do this in a relatively simple manner. If you're interested and can you do that, you need to call and talk to the capital markets team and say, hey, I want to contribute my note over. Or you can obviously invest cash, new investment cash, and that's in obviously qualified and non-qualified money. I'm talking about your self-directed IRAs, which I'll get into in a minute. But right now, what's the makeup look like in terms of how did we get in? It looks like about a quarter of you have come in with your existing notes, your loans, and 3/4 of you have come in with cash. Growth versus income. So what are you doing with that? This is interesting and affects everybody in the fund because it talks about allowing us to actually grow the fund with existing dollars. So many of you, in fact, the majority, 61%, are choosing to take advantage of compounding interest. So your money is staying in the fund and being reinvested on a quarterly basis. This is obviously the best way to maximize your returns, but about, what is that number? So 39% are taking income. Well, this is a very nice flexible product that we have, so you can choose to either reinvest that capital that you're earning, or you can take the income off of it as well. Another neat feature that maybe we don't talk about that much is that you could actually change the selection if you needed to on an annual basis. So once per year, if you said, hey, I want to switch it over to growth, I don't actually need this income right now. That's a great way for you to take advantage of the compounding interest, and you can be there. Conversely, if you needed the income, you could switch it the other way as well. Again, you can only do that about once per year. If you need to talk to anybody about that in capital markets, they can help you with that. All right, what kind of mixture is there of the money inside? This doesn't necessarily matter but to you as the investor, but it's just an interesting fact, and it's very close to 50-50. You see it's just a little bit more qualified, that's self-directed funds, as opposed to non-qualified cash. What's the difference here in terms of why is this good? Well, if you have self-directed IRA money and you're working with, say, Mainstar, who we prefer that you work with because they've our experience is they have the best fees and the fastest turnaround time, you can limit your fees actually. So instead of making an investment every single time into a different loan, you can make an investment one time into the fund, and then your money consistently performs, limiting the fees that you have, which is a great benefit. All right, so portfolio fund and REO performance. You know, we really haven't talked too much about the portfolio fund with our existing clientele, but yes, we do have another fund that's available, and that fund's entire mission is to actually go out and refinance and finish the development of REOs. What is an REO? It's not necessarily the best acronym, but it means that it's a foreclosed property. Noble Capital, on your behalf, has foreclosed on the property and taken it over. And then what happens beyond that point? Well, a number of different things can possibly happen. So it's a little bit unique to every single deal. Our preference is that we jump in and we start working on the property and take it to the end and the goal line and sell that property. And that's really what we're targeting in here. So let's take a look at some of this data. The slide was really busy last quarter. It's a little less busy this time, but it's still very important. There's a lot of information in here, and I really want to point to one thing that's important, and that is this is the entire portfolio that we have that can be built into the portfolio fund. Many of you, however, are still direct lenders inside of this fund, and that's fine. You've chosen to remain so, but just as a tip, if you're interested, you could actually contribute that portion of the portfolio fund. The portfolio fund has a lower rate of return and a different minimum investment, but there's one really important distinction on the portfolio fund that's different than anything else that we do here, and that is that Noble Capital, as an institution, we stand behind the payments on the portfolio fund. So we're the ones making those payments, and that's the only place where that exists. It's a great place to be. But let's take a look at something that's important in terms of total dollars. The slide, the actual graphs here is not telling in terms of like dollars that are actually spent. In fact, the graph, the first thing you see is actually loan to value. We're trying to illustrate over time there's more exposure in a property. Now that's normal whether you're the borrower that ended up flipping the property or you're us, because there's carry costs. But the really important part are these little flags that you see sticking up. And I want to draw your attention to one of the ones in the middle that's at 50% loan to value. There are 14 loans or failed products that we took over that are actually under construction. So we've really made a significant increase in our efforts and design in our basically disposition team. And now that's Emerge Real Estate. They're out there working on, we have 14 projects throughout the state of Texas that are under construction. And if you move to the right one, you see that we've got 9 that are for sale. Again, this was at the time of the end of the third quarter. We've actually already sold 4 of those 9 loans that were here. So the products are now moving. So if you're involved in an REO and you're wondering what's the status, we obviously have the status. We obviously are able to look at this data from a metric standpoint. And now we're able to demonstrate success. And we're doing that by selling these properties. So they are starting to roll off, which is fantastic. Honestly, just to be candid, it took us a while to build out this department, but it's working really well. It is streamlined, to use a pun there, but it's working out pretty well, and the products are moving off. All right, so we've got some questions coming up, got some Q&A. I'm going to be joined by Grady Collins, the CFO on these, so he might tend to pitch in a little bit of some of these answers so that I don't have to answer them all by myself, but we thought having Grady on here would be great too. So let's jump right in and look at some of the first questions. These were submitted by you, our listeners, our lenders, our investors, and so we just abbreviated your initials so you can make sure you see if your initials are up there. This is a question that came from you. So first question, I would like to see a status of current projects. So we probably should have gotten some clarity on what do you mean by this, because does that mean current projects, meaning current offerings, new loan opportunities that you have? Because we do have a loan gallery. It's an online portal that you can actually go to, and you can actually see what loans are available for you to immediately jump into. If the question, however, was, I want to see the current status of projects of loans that you're involved in, so a couple of things. One, our private lender program, where you're a direct participant in a loan, it's very, very difficult for us to provide updates like that. So and that's really not what our offering is about. That level of granularity on a project by project basis that you may be a lender on is not realistic for us, and it really just boils down to a numbers game. We have too many properties for us to provide that many updates to every single fractional lender. We did the math, I think, before this, and it would be something like 1,600 updates, on a monthly basis. That's just not realistic. However, if you look at the fund, and that's kind of the idea behind the fund, you're getting added diversity. So you're not exposed into any one single property. You've actually got diversification across the entire portfolio that's inside of that fund. So that's probably a better way. However, I will say this much. If you're involved in a foreclosure and REO, where we've certainly made changes to our communication strategies here, and we're communicating on a monthly basis as to what's going on inside of that project. So if you're not getting that level of communication, please be sure and let us know so we can make sure that you are. Next question, how does the hurricane in Houston affect the strength of the Signature Fund? Good question, and topical, of course. I want to broaden it out and talk about basically how does it affect Noble Capital in general, or all of our loans, not just the Signature Fund, but the same answer will apply. First of all, let me give you some metrics. And by the way, we did cover this in one of our previous newsletters. We sent out some of this data, but we had 44, I believe at the time, 44 loans in the greater Houston area at the time that Harvey actually struck. We went out and inspected all of those loans. So we had boots on the ground, went and took actual review of every single one of these. And of that, we only had 4 that had anything anywhere close to any damage. We were very, very fortunate. And we only had 2 that actually had real damage. And by the time we had boots on the ground reviewing those properties, they were already being, the sheetrock being torn out and that kind of thing. So Harvey's a big deal. I don't want to minimize it. I do want to talk about it. And I think the best way to do it is at a higher level, some of the economics that have changed in Houston post-Harvey. And that is that if you had a property that was not flooded post-Harvey, you were essentially worth more the very next day. If you were marked as, quote, dry, your property is worth more. So if you look at us, we have a portfolio of 44 properties that were virtually all dry. We instantly got some lift. And the nice part, which is also encouraging, is some of those REOs, those foreclosures that we sold, 2 of them were in Houston. And they were in an area that did not receive flooding. If you followed us closely, we have a lot of properties in the Heights area. And I guess they don't call it the Heights for nothing. It is higher than the other areas. So it didn't have as much exposure. But on the other side, if you did see flooding, what we're seeing right now in the general marketplace from all around the country is generally from an investor standpoint, the enthusiasm of the opportunity that's being created there. So there are people that need to sell their homes and are ready to sell it at a value and essentially allow someone to come in, make renovations, and capitalize on that. So there's actually an increased demand for private lending in the Houston area. There's a lot of federal dollars that have been coming in there that are helping people really get back ahead. And I don't want to marginalize the impact that it had on people on the human side because that's terrible. But from a real estate standpoint, it's really provided a lot of opportunities for us. So I hope that answers your question. In short, we didn't have a lot of exposure. We were very fortunate, and it's actually created some opportunities. My concern is how things are going in the Houston area and how is this impacting Noble Capital overall. I think that's a little bit, I think I covered that in the last one, so I hope I did. I'm going to move on to the next question. This one might be for Grady. Current tax liabilities with interest dividends, you should have an accountant explain just how bad the tax liabilities are with our dividends. Everyone likes higher returns for investments, but the liabilities of our federal tax rates are ridiculous. So without being political and discussing the potential tax changes, and then Grady's also not an accountant, so there's my disclosure of the day. Neither am I.
I'm just not a certified public accountant.
Oh, okay, not a CPA.
Correct.
Got it. Okay. Well, Grady, give us a little hit on this, please.
First thing, it's interest income. It's not dividends. Dividends are something that shareholders receive as ownership of public corporations normally. This is interest income, and the liabilities of the federal tax rates are ridiculous. However, we do not control that. That's set obviously by the federal government. And so because you're getting a higher yield, yes, you're going to pay a little bit higher in ordinary income tax each year, but it beats the alternative of putting the money in a savings account and not in getting a very high yield, but you're also knocking your tax liability down a little bit. So sometimes with the higher yield, there are some a little bit of downside, but yes, you do have to pay the government a little extra. However, hopefully you are making a lot more than you would with another investment.
Yeah, and I would add to this, yes, this is ordinary income, is how it gets tabulated for people. So, your tax strategy is something that you need to be considering of when you're making any type of investment. That's something that if you're interested, that's something that we can actually help you with. We do offer retirement planning at Noble Capital through our sister organization, Acute Financial. We're happy to meet with any of you that have a tax issue or consideration. Proper planning for your investment strategy long term, especially when you're in retirement, there's a major tax considerations for that. So yeah, valid point. It is taxes, but it's also income. And you make more money, you pay more taxes, and that's out of our control. I should end with saying this. Our entire offering is to create income. We're not creating tax strategies at Noble per se. So that's something that you definitely want to come back and look at. And again, we have financial advisory services that can definitely help you with some of those questions. What's going on with your foreclosures? So kind of had a section on that. So I think that answered it, but I can give you some more highlights here. What's going on is that we're making enormous amounts of progress on construction. At any given time, we have between 12 and 16 properties that we actually have people that are working at those projects. And now they're actually hitting the market and selling. So I know it's been a little frustrating for some of you in a foreclosure where, we haven't been able to make progress, but now we have. And furthermore, we've actually been able to sell several of these. So I know many of you on this webinar or call here have actually received your payoff finally in some of these foreclosures that we had. So it does take some time, and we've worked our way through that. And that's, again, one of the core tenets of why we only lend at 70 cents on the dollar. It's so that when we do get the property back, we have sufficient equity and time to finish the project and sell it. So again, if you're not getting an update in a foreclosed property that you're in, please let us know so we can make sure that you're getting your updates. We're certainly committed to providing those out on a monthly basis so that you know what's going on. When do we receive our dividends from the Signature Fund for the quarter? I'm going to let Grady cover that a little bit, and then I might be able to add in.
Yeah, I can respond to that one. First of all, it's not dividends, it's interest income. The way the government looks at those is a little different, so let's just be clear that it is interest income. The Signature Fund interest income, the ones that chose the income distributions, went out last week, which is a little later than we wanted to. We're working with the fund manager, U.S. Capital Partners, and the fund admin to turn them around a little bit faster. So hopefully for Q4, hopefully we can have them out sometime between the 15th and the 20th of January, and not the end of January or even early February like it was this quarter. Because the fund is so new, we've had so many new people go in, new subscriptions. There's teamwork that's involved between us, the fund admin, and U.S. Capital Partners, and getting everybody on the same page. So we're working very hard to get that turnaround time down significantly.
Great. The new checks have numbers across the bottom so small, my bank can't read them on the pictures I send to make deposits. I haven't had this problem with any other checks. How about making the numbers big enough so I don't have to mail in my deposits from Noble? It's really a pain to have to use snail mail. Only with Noble. Okay, few things here. First of all, totally legit, and if you haven't received a new check and tried to do this, you may actually have this problem. I am speaking for myself. I'm actually an investor at Noble with my own personal money, and I got a paper check, and I bank with Chase Bank, and I took a picture of it, and it failed. I had to literally go to the bank and make a deposit. So I hear you on that. I encourage you to do the exact same thing I did, which was sign up for ACH direct deposit, so that you're not getting a paper check and then having to take a picture of it. I think that's probably the best solution for everyone is to sign up. You'll get your money faster. It goes in. We do ACH direct deposits on a weekly basis, and then you just get a statement instead of having to take a picture of it and upload it. However, for those of you that are going to be insistent on having a paper check, and I understand that, we are trying to figure out what's going on. This is pretty peculiar, and we are diving into it, but I have actually replicated this, so I know this is a legitimate thing. But again, I signed up for ACH just so I don't have to deal with it anymore. I think everybody should do that. What types of opportunities are you seeing as a result of Hurricane Harvey? A lot of interest on Hurricane Harvey. I think I covered that again. The opportunities actually are pretty large. We're selling out our REOs now because they're worth more money than they were yesterday because they're dry, quote unquote. And the other thing is we're seeing a lot of demand right now on housing. So if you were in a flooded home, you may not be able to stay there, and you may be looking for more housing. It's driving up some of the rental rates in the Houston area because people are looking for short-term solutions. So that's an interesting thing. I know there's a lot of institutional investors that are coming in and trying to buy up as many of these flooded properties as possible because they're going to make great rental properties. So there's opportunities there. Is there opportunities for us? Yes. In the areas that we tend to focus in, didn't see a lot of flooding though. So we're still going to be lending in Houston just like we always have because it's one of the largest cities in the United States and people aren't going to be leaving it anytime soon. But valid concerns. I think we addressed the Harvey issue at this point. I want to be able to see a list of available projects. Kind of ties into the previous question. The Loan Gallery is a great place to do that. Some of you requested to get those emails where we talked about immediate loan opportunities, so we brought that back. We actually stopped doing that for a while. So if you're not watching your emails, that's how we used to do it. We used to only announce via email. So we brought that back. That's the request to some of you. Hopefully that's satisfying your itch to know when we have a new project. But you can also go online and check it out. Again, all this is available at our website at noblecapital.com. Again, another Hurricane Harvey question. I think we beat that to death. I'll move on. I want to roll over my payoffs into the signature fund. Do I have to get set up as an accredited investor each time? Okay, so the answer is maybe. And to try and keep this short, yes, you do have to get set up as an accredited investor when you go in the first time. If you do it again within the same calendar year, you just have to show them your last tax return. And they add that in and they're like, okay, great, an accredited investor, moving on. So you don't have to go through that entire process a second time if you just show them a copy of your tax return. I wish it was a little easier than that. Unfortunately, with larger funds, we have to obey by the regulations that are set forth by the SEC, so we don't necessarily have a choice here. But yeah, so that's the shortcut.
Yeah, just one other thing with that is you can also contribute your loans to the signature fund so that you can just do it all at one time. You don't have to wait for the loan to pay off. Now, there may be a few small exceptions that the loan may not qualify for the signature fund for whatever reason. But for the most part, you can take any existing cash that you have and existing loans that you have and roll them all in there at one time so you don't have to worry about getting accredited over and over and over again.
There you go. This is another Houston question. Again, if you were, but I do want to, this is actually getting into some specificity. If you were actually involved in one of the 2 or 4 loans that we actually saw some damages at, you got a special follow-up and a phone call on that. So there were only a few of them. Again, that's why, we have insurance on these properties. That's why we had inspectors on the ground. So if you were involved in that, you know about it. I just received an email about my first loan paying off. Who do I talk to reinvest or weigh my options? You or Brooklyn? We added the advisor parentheses so that everybody know who that is. Brooklyn's actually a financial advisor out of the San Antonio and Houston markets that has clients that are participating at Noble Capital. Many of you have financial advisors that are not Acute Financial, which is our in-house advisory. We do work with other advisors. So the answer for this specific person might be it depends. Your advisor may be helping you with some of those decisions, or you could just call Noble Capital. So if you're in control and this is an allocation that you set up with your financial advisor, you can just give us a call and we'll talk about the options that are available for you presently and show you where the loan gallery is. There's a number of ways to do this. But, if you have any friends, and that's just an FYI, if any of you are financial advisors or you know anyone, kind of a little bit of a news flash maybe, but we can actually offer our products to other financial advisors and their clients. And those financial advisors, and we're talking about, generally speaking, like, RIA, registered investment advisors, they can get paid for these referrals. So we do appreciate that. And Brooklyn's a great partner that we have doing that with us now. All right, that was the blitz there, the Q&A blitz. Well, thanks, Grady, for the 2 follow-ups. We got a couple of announcements here to make. We like to brag a little bit about some of our employees. We have this thing, the Griffin Award, for those of you that haven't seen this before. Every quarter, this is kind of like Employee of the Month, but it means so much more than that to us. This is the person internally that really best exemplifies the tradition of Noble Capital in our Griffin and our core values. So these are some of the previous recipients. We thought we'd at least brag a little bit here on the call of this quarter's Griffin Award recipient, and that's Miss Erin Famas. Erin works in loan operations, has been with us almost about a year now, and Erin is someone that you may really be appreciative, and you just don't know it, because she actually handles the operations for the loan servicing department. So she's the one that helped with the automation project that was recently completed. And one of the reasons why you may have recently seen two statements, like a little bit of an overlap, is because we moved from manual statements, which admittedly are prone to having errors, to an automated statement system that generates directly out of our loan servicing system, and Erin deserves the majority of the credit for that. So really appreciate what she's done for everything that we've done here. So Erin is the recipient of that award. So yeah, if we had the button where the applause was to roll, this would be the time, right? So okay. Couple of other things for those of you that may or may not know, we actually have a radio show going on called the Retirement Blueprint, where you hear Romney and myself and a number of other people at Noble Capital and our partners. But we put on dinner seminars. We just wanted to throw this out there and let you guys know that our financial planning division, Acute Financial, has dinner seminars both in Austin as well as Dallas. And if you're interested in bringing a referral or letting anybody know about what we do, we obviously cover private lending as a major section at these dinner seminars. You're welcome to come and attend with your referral. And here's some dates we wanted to throw up there. If you're interested and you want to register, the easiest way to do that is to do it actually at retirement, at our realwealthblueprint.com. So that's a place you can do that at. You can also go to acutefinancial.com and register, or just call anybody up here and we'll figure out a date that works for you. So we at least wanted to let you guys know that you're invited to. Just bring a referral. Okay, it's the holiday season. We like holiday parties. So we're actually going to have an appreciation event. This will be kind of fun. We want you all to attend if possible. And it's going to be in Austin. So for those of you that are clients outside of Austin, and we do have you guys, especially up in Dallas where we have another office, it's going to be in Austin. It's December the 12th, and it's going to be actually at one of our properties. So when you talked about foreclosures and you wanted to know how does Noble handle its foreclosures, I would love for you to come and take a look at this property. This is a failed loan that we took over, completed it, and now we're marketing it and putting it on the market. And when that property sells, we're going to be exiting out of that. So this is a cornerstone of our entire program. This is how we protect you. We're able to run through disposition and get you out of these investments. So we thought, what better way to highlight that than to have a party at one of these properties. So it's here in Austin. It's going to be some other stuff. We've got a little bit of a charity partnership going on, and I think you have to wear an ugly sweater. So anyway, just kidding. But no, seriously, wear an ugly sweater. It's going to be Tuesday, December the 12th. I'd love to see everybody there. Everybody from the Capital Markets team will be there. Please RSVP with the Capital Markets team. All right, so this was a digital version of the state of the company. Makes it a little easier to hold, but we're going to do our in-person big event, and the next one will be in January 2018. So that's going to be the one in person. It'll be at a venue where we'll bring you guys in and we'll talk to you about the facts. Try to keep it a little bit shorter. We've taken a lot of feedback into consideration from many of you of what you want to see and what you don't want to see. So we're listening to that, and we really do appreciate that feedback. You'll get to save the date sometime soon, later this year. But of course, we're going to have one in January, and it'll be an in-person event. All right. I think that's it, and I really appreciate your time whenever you did download this, and it's in an email and it's archived. So again, this was our 2017 Q3 State of the Company. Thank you very much for your confidence in Noble Capital.